Hey everybody, how's everybody doing? Welcome to our Power of Real Estate show, where I'm talking today about the 4 benefits of rising interest rates. And I know this is a controversial subject. A lot of people don't think there are any benefits to rising interest rates. I'm coming in here to make sure we are live. We are good and we are live. So good to see everybody. I'm excited to talk about interest rates today. A lot of people want to know what is going on with the interest rates going up, what's it going to do to the real estate market, and what should we be prepared for? What should we be prepared for? Let me make sure we are good here. Everything looks good on our end. There we are. So we are going to, there we go. There we go. Awesome. Do rising interest rates affect you positively? So do interest rates affect you positively? I'm going to be talking about the interest rates because throughout COVID-19, as we saw in 2020, 2021, we saw interest rates massively plummet. And so with it massively plummeting, what does that do to the real estate market? What does that do to everything as a whole? Well, of course, it speeds up buying. It speeds up people getting into the market. It speeds up people making decision to buy possibly rather than rent. And so it changes a little bit of the buying patterns and speeds up. So what we had and what created such an interesting frenzy is we had shortened inventory, massive amount of demand, and massive amount of buyers, which of course drove up housing prices. Right. So now we've got the interest rates coming down, going up. What does that actually mean? Well, as interest rates go up, a lot of people make poor deductions based on the interest rates rising. So people, as the interest rates are going up, people are assuming, oh no, the housing market's going to slow down, the housing market's going to crash. And so they a lot of times base the housing market strength off of the interest rate. But we've seen really powerful, strong real estate markets in 6-7 interest rate markets where we've experienced 2 and 3. My wife and I bought a house in Phoenix, Arizona. We got it at 2.8%. Crazy, almost free money in our personal residence. And so if we're basing it on this, we're going to see these rising interest rates as a problem. But we have to understand this is an abnormal low. So as interest rates are rising, I actually think about them as they're normalizing. Interest rates are starting to normalize a little bit. And in some ways, that's really healthy. And we're going to talk about why. So there's a couple things you have to understand in real estate. There's really only one thing that crashes a market in real estate. There's one thing. Now, there's a couple things that can drive this one thing. But the one thing that crashes a real estate market is when demand is way behind supply. So if there's a lot more supply than there is demand, guess what we have? We have a crash. That's what happened in 0809. 0809, banks were giving out money like it was just water, giving it to everybody. And people couldn't make those payments because a lot of them were on adjustable rate mortgages or ARM loans. And when those payments came to raise, when it was adjusted and the interest rates went up and their payments went up, they couldn't afford those homes. So a bunch of homes were thrust to the market. So we had a lot of supply and the demand really didn't change. Well, what do you have? You have a crash. And so right now we're in an interesting major difference in that we have millions, depending on which data points you follow. It could be anywhere from 3 to 4.5 million more buyers than we have homes. You go to a city like Denver, Colorado, at the end of 2021, there was like 800 or 900 listings in Denver. We're not talking about, Podunk, Iowa. We're talking Denver, right? And by the way, if you live in Iowa, I love Iowa. And so, but you're talking about big cities only have limited listings. Austin, limited listings because people want to live there. So the point is, when you have that shrinking of supply with massive demand, what do you have? Increase in prices. And so with interest rates rising, it's not necessarily going to crash the market, but it can change the way the market operates a little bit. Robert Shiller, who puts out the Shiller Report, who's one of a great economist, especially when it comes to mortgage rates and what interest rates, how do they relate to the housing market? And Robert Shiller in his report says interest rates don't really decrease home prices, and they don't really slow home buying. They just change the kind of home people buy. So if I'm going to buy a $700,000 home, I might shrink to a 6, or if I want to buy a $200,000 home, I'm going to shrink to maybe $150,000, $160,000 home. I'm going to adjust. So it doesn't necessarily change how I go about real estate. It just changes, or it doesn't change if, it changes how, right? So there's 4 benefits that I see when I see the interest rates rising that are really, really important. 4 things that I see. And then I'm going to talk a little bit at the end of this video on this broadcast on how you should be responding. What should you be doing as the interest rates rise? So the first thing is, when interest rates rise, it strengthens the value of the US dollar. So anytime the government prints a bunch of money, it lowers the value of the dollar because there's more in circulation. Again, anytime there's more of something, it's worth less, right? It's not worthless, but it's worth less money. So if you have more in circulation, it's worth less money. So they throw a bunch more money into the economy, even though it's called an economic stimulus, it decreases the value of the dollar because there's more in circulation. So when they print, the value of the dollar goes down. We saw this in 08, 09, $800 billion to bail out the banks, prints a bunch of money, the value of the dollar goes down. And that's going to happen now. That's happening already now too. The value of the dollar is decreasing. But when interest rates go up and money's harder to get, meaning it costs more to borrow it, what does that say about the US dollar? It raises the value of that US dollar and it attracts overseas capital. Other people from overseas, when interest rates go up and it strengthens that dollar, other people come and bring their money to the States because it's a stronger dollar. They move their currency into States in exchange for more expensive currency that has the ability to appreciate just like a piece of real estate does, right? But exchange rates and exchange, they have a lot of factors, but rising interest rates are one of them. So it can strengthen the value of the dollar. Big thing to think about when you're thinking of these rising interest rates, because when people are talking about it, man, they're talking about it like it's the end. People forget that back in the 80s, people were borrowing at 17-18%, right? And so we're talking a long ways from where we are now, right? So as interest rates go up, though, I do want you to start thinking there are some benefits. One is the strengthening of the US dollar. Number 2, it will tame inflation. It'll tame inflation because it slows down spending a little bit. It'll tame inflation. Now, the backside of tamed inflation, when there's not as much money flying throughout the economy doesn't rise as strong. But as the Schiller report and some other reports have projected, interest rates usually rise with a rising economy because the dollar is getting stronger, and it's a way to get the dollar stronger. So I want you to understand it does tame inflation, and it's often a sense that the economy is strengthening. That's not always the case, but that seems to be the case now because we have lots of jobs, lots of people that need workers because there are more demand for their product than they even have the ability to produce. And so that's a good thing that it's taming inflation. The third thing is more lending. And I know you're like, wait, what do you mean more lending? I thought that you know, when interest rates go up, people borrow less. Remember, if the dollar's stronger, there's more, it's more important that people get a hold of it because it's worth more money. I love what Sean Snaith from Universal Central Florida, I'll read a quote from you. It says, banks may have a greater incentive to loan out reserves at higher interest rates, and the increased flow of additional credit would boost economic growth. So I'll read that again. Banks may have a greater incentive to loan out reserves at a higher interest rate, and that increased flow of additional credit will boost economic growth. Again, that's Sean Snaith for the Institute of Economic Competitiveness down at University of Central Florida. The truth is that often rising interest rates explain a rising economy, a strengthening economy. So you don't just look at interest rates that are rising and assume, oh, the real estate market's going to crash, everything's going to come down. That's not necessarily the case. In some ways, it strengthens the dollar. Now, it's more expensive to walk through that economic environment, but the value of having a strengthened dollar is when the interest rates do come down, you have a dollar that's much, much stronger to borrow against. And then the fourth thing and this is one of my favorite things, if you saw back in the 80s when interest rates were 17-18%, a lot of people sold their homes on seller financing. If you don't know what seller financing is when the owner is the bank and you just pay that owner on payments, right? You just pay that owner on payments. And so I think as interest rates go up, seller financing is really going to increase. You're going to be able to get more deals on seller financing than you did before. And seller financing is a powerful way to get into deals where you don't have to leverage banks, you don't have to leverage institutional money, and you can get into deals that you maybe couldn't get loans for. So this is one of the ways that we started building our real estate portfolios. We started asking for seller financing. Hey, Philip, good to see you today. Good to see you today, my friend. Always great gems. Thank you so much, my brother. Appreciate you tuning in. And so again, I just want to continue to help you understand that just because interest rates are going up do not mean we're going down. And seller financing is another great benefit of a rising interest rate. Because think about this. If they do hit 7, 8, 9%, and somebody says, you know what, I'll sell it to you at the same as the bank, but then you don't have to go through any of that, and they're making 8% on their equity, because if they sold that money, they'd have to put that somewhere. They can make 8% and not do anything, not even have to worry about, all of the things of selling a home and where to put that money and all that good stuff. They just leave it in their home and make 8%. That's a powerful incentive. And so you have to understand that rising interest rates increases the likelihood of seller financing or home financing or subject to deals. And that's actually a sub point to that is more subject to deals and rising interest rates, more subject to deals come available. Subject to is when I take over somebody's mortgage payments and I just take over all their debt and take the home and they can just walk and move on. And there's a lot of different ways to do this. But when people do get in, maybe they got a loan and it is adjustable and it starts to raise and they can't pay it anymore, they would gladly give their home to an investor, and you could come in, take over those payments, rent that place out, and manage that property as a rental property. Again, yet another benefit of rising interest rates indirectly. This is not something to look at and be fearful of. It's something to look at with a strategy eye. You have to look at it from a strategist perspective. Real estate cannot happen with a fear-based mindset. You cannot come at real estate with fear. You have to come at real estate with knowledge and wisdom. You have to come at it and make good, healthy, fundamental decisions. And that's true in every market. So question, Mike, Mike, how do I reply to the rising interest rates? What do I do? Well, don't focus on interest rates, focus on strategy. Don't focus on interest rates, focus on strategy. Here's what that means. Focusing on strategy says, okay, if I'm going to buy a home, a personal home, like my primary residence, I'm going to make sure that as the rising interest rates will make my payment more, I'm going to make sure that payment doesn't go above my budget. I'm not going to just bop in. If I was going to buy a $500,000 home, and that's kind of as much as I can afford, then interest rates go from 4 to 5.5, and that $200 payment turns into a $2,700 payment. I don't do that. I'm not gonna go and gamble with those numbers, right? So if you're buying a personal home, you make sure the payment still fits in your budget. So instead of a $500,000 home, bounce down to a $450,000 or $425,000 to make sure you adjust for the monthly payment adjustment in that interest rate so you can cover that payment. Don't get yourself overextended, and don't allow the rising interest rate to put you in a compromised debt position, right? And so the other side of that coin is the investor coin. Or is the investor side of that coin. So if you're going to buy a primary residence, make sure you adjust. It's the same with investment. So on investing, if I'm buying a property for cash flow and the interest rates have gone up, meaning my mortgage payments can be higher, then you adjust to make sure it still cash flows. So maybe you bring the price down a little bit. I will say rising interest rates in commercial real estate will often bring the prices down a little bit because we're cash flow based investors. We invest based on cash flow and appreciation. Now, if we're only investing on appreciation, interest rates don't matter. We don't care. We need to make sure it can make payments. We're not coming out of pocket. But if I'm investing, it doesn't really make that much money, but in 5 years, I'm going to sell it for a significant increase. Well, then the interest rates don't really play as big of a role as long as the property can still make the payments. But when you're buying a cash producing asset like investing, and the interest rates go up, you have to re-underwrite the property and make sure you're insulated against that higher interest rate. Okay, insulated against that higher interest rate. So when interest rates are rising like this, lock in at the lowest amount you can, and then cash flow that property. This is why people say debt is a hedge against inflation, because you're borrowing against a stronger dollar. You borrow against a dollar, and then as inflation goes up, guess what? When you borrow in debt, your debt doesn't move. You pay the same interest rate, the same payment, no matter what happens to the dollar. But what does go up? Inflation does bring rent up. So when you borrow at $1, borrow debt, and that debt's not going to change, but inflation takes your income up, you get to benefit from inflation, but not have to have your debt be impacted by inflation. That's the importance of understanding rising interest rates. Why lock in, especially when they're moving up, get ahead of this, right? Because interest rates going up is going to make it harder to make money on a cash producing asset, but the sellers are probably going to have to bring their price down. Now, some of them won't, and they'll just hold on to their property. It might change if they sell. And we've actually seen in the multifamily space, even we've seen a kind of a shortage of inventory over the last 2 years throughout COVID. And we've even seen a shorter inventory right now as interest rates are rising, because interest rates rising are kind of like if you're in a crowded room and a loud noise goes off. What does everybody do? Just pause. And right now, investors are paused and they're waiting to see the loud noise, waiting, looking around to see if they need to run or everything's safe and they can just start moving again. So interest rates are kind of like a loud noise in a crowded room. It causes people to pause and look around. And that's what's happening right now. And I think we're seeing a lot of sellers that were thinking about selling. They're like, I just want to wait and see, because if I'm going to have to take another $400,000 or $500,000 off this property, I might just hold on to it and let it cash flow for a while until interest rates kind of pan out and I can raise rents and then sell it or something like that. But again, understanding the 4 benefits of rising interest rates. Number 1, the increasing strengthening of the dollar. Number 2, it tames inflation. Number 3, it there's more lending because banks want to get this money out at a higher interest rate. So they're going to create great programs to get that money out because they're going to make more money the more they lend. And so it's going to create more money into the economy. And then 4, it's going to open up seller financing and subject to opportunities, because people are going to see how much the banks are making and match or even beat that and not have to go, and you won't even have to go to an institutional bank. But responding to it, remember, if you're buying your own home, you want to adjust the size and price of home you buy to make sure you make that payment. And on the investing side, you want to adjust what you pay for it in order to make sure it still cash flows. So just wanted to hop on for a few minutes today and talk a little bit about some benefits of the raising interest rates so you don't get freaked out and you can think like a real estate investor. We think like strategists. There's never a time to stop buying real estate. There's just a time to change your strategy. In 2008, 2009, the real estate market crashed. That was the best time to buy real estate in the last 30 years. So it was a great time to buy. You had to change your strategy. You had to shift around your strategy and not just continuing to do what you've always done. And same thing right in the last 2 years. Great time to buy real estate. You had to change your strategy a bit. It was not the best time to buy office space. But again, it's a great time to buy. It's a great time to buy commercial real estate and cash producing assets. So you just have to shift your strategy, but you never don't buy. You just shift strategy. I love y'all. Make sure to subscribe to the channel. Join our family of entrepreneurs. We love helping entrepreneurs or real estate investors build their businesses, grow their revenue, and impact people. Love you all. Have a fantastic day. I'll see you next Tuesday. Sorry, we came live one day late this week. We were doing some filming yesterday. So next week we'll be back on our schedule on Tuesdays at 3 p.m. Pacific time. Love you all. Have a great week.